the market just experienced a massive headline whipsaw. President Trump hinted the Iran war is nearly over, sending oil crashing 15% and pushing the Nasdaq and Bitcoin into the green. But look beneath the surface. The Pentagon is vowing to fight on, the Strait of Hormuz is still closed, and a major UAE refinery just got hit. Welcome to the Tuesday close.
I mean, the price action on the tape today was just, it was historic. We literally watched the Dow, S&P, and the Nasdaq just absolutely rip upward in, what, a matter of minutes?
Yeah, minutes.
Right, and Bitcoin broke and held above that critical $70,000 resistance level. And if you were tracking the order flow like we always do, you saw this massive algorithmic capitulation across the board. It was entirely driven by a geopolitical headline risk vacuum.
Welcome to this afternoon's deep dive on Theta Fuse. Our mission today is highly specific, and look, we are not going to waste any time. We're looking past all the political noise to break down a massive stack of closing bell sources.
Oh yeah, a huge stack today.
Right, including the latest EIA reports, multi-billion-dollar corporate acquisitions, live Pentagon briefings, and the raw commodities data crossing the desk. We are hunting for the structural long-term trades here. If you are tuning in to day trade the intraday panic, you are definitely in the wrong place.
Exactly. You're going to get chopped up.
Yeah. We are here to analyze the underlying market mechanics and position your portfolio for the macro shifts that institutional capital is currently front-running.
Because finding those structural setups, it requires an absolute decoupling of the physical market reality from the equities market sentiment. And today provided just a textbook study in how natural language processing algorithms and retail momentum can completely detach from physical supply chain constraints.
It's wild to watch.
It really is. I mean, the broad market basically priced in a total return to global logistical stability by 2 p.m. Eastern. While the underlying commodities data, like the actual physical movement of molecules, suggest we're entrenched in one of the most severe supply disruptions of, well, the modern era.
Yeah, the oil paradox we saw today is just the perfect entry point for this deep dive. The disconnect between the political sound bites and the crude futures market was violently aggressive. So the primary catalyst was President Trump's interview with CBS News.
Right.
The algorithms instantly scraped his exact phrasing where he stated the war is, quote, very complete, pretty much, and that the U.S. is very far ahead of schedule.
And when you look at the microstructure of the market, the literal second that headline hit the terminals, it was a cascade of triggered sell stops. The NLP algos read the semantic sentiment of war is complete and just immediately dumped front-month crude futures.
Just dumped them.
Yeah, West Texas Intermediate capitulated down to $80 a barrel. And Brent crude, which is, the benchmark we really care about for global transit, it experienced a massive 11% peak-to-trough decline. It settled in to trade near $82 a barrel.
But putting that retracement into context, I mean, you have to look at the weekly chart. Sunday night, as the Asian session opened, both Brent and WTI were testing the upper bounds of $119 per barrel.
Yeah.
Even earlier today, before the CBS interview dropped, Brent was swinging around the $94 handle and had been holding a really strong technical level above $100 for the bulk of the previous session. So shaving off that much premium down to $82 in a matter of hours is it's a staggering evaporation of implied volatility.
It is. And adding fuel to that algorithmic fire was a secondary catalyst that hit the feeds shortly after. Energy Secretary Chris Wright posted an update on social media claiming the U.S. Navy had successfully escorted a commercial tanker through the Strait of Hormuz.
Right, the deleted post.
Exactly. It was quickly deleted. But, I mean, in modern market structure, a deleted post lives forever in the high-frequency trading models. It doesn't matter if it's gone.
Yeah, the algos already ate it.
Yeah. Exactly. So when you combine that phantom data point with Trump's earlier press conference claims about waiving oil-related sanctions to ease transit, the market's pricing models violently adjusted to assume this, immediate friction-free reopening of the Middle Eastern energy corridor.
And look, as traders who manage risk, we have to enforce strict political impartiality here. It is totally irrelevant whether these statements are strategic political posturing or genuine optimism or just miscommunications.
Right. Our capital doesn't vote.
It doesn't care.
Yeah.
Our capital does not care about the political motivations behind a press briefing. We only care about the factual, verifiable, on-the-ground data and how that data translates into structural market inefficiencies.
The tape is the only truth that matters. And right now, the tape is bifurcated. The equity side is trading a political narrative while the physical commodity side is dealing with, well, Kinetic reality.
Which brings me to this mandatory warning for you, the listener. Do not confuse a political headline with a restored supply chain.
Amen to that. A politician stepping up to a microphone to declare a conflict is winding down does not instantly repair the structural integrity of a bombed pipeline.
Nope.
It doesn't lower the prohibitive war risk insurance premiums required by Lloyd's of London to sail a very large crude carrier into a conflict zone. The physical constraints remain entirely intact regardless of what the sentiment shift on the S&P 500 is doing.
Yeah, and to really quantify those physical constraints, we have to look at the earnings call from Saudi Aramco that took place this Tuesday morning. Because CEO Amin Nasser delivered an incredibly stark assessment.
He did.
He categorized this current phase of the Iran war as the biggest crisis the region's oil and gas industry has faced. Coming from the head of the most valuable energy company on the planet, that language is deliberate. It is calibrated.
Oh, absolutely. Nasser's breakdown of the systemic risk was particularly telling. He outlined a severe chain reaction, and he wasn't speaking in, abstract macroeconomic terms.
No, he was very specific.
Right. He pointed to the cascading failure points: shipping, insurance, aviation, agriculture, and the automotive industry. When the cost of moving a physical molecule of energy spikes, every single derivative industry downstream absorbs that margin compression.
It's the ultimate domino effect. When diesel spikes, freight rates spike. When freight rates spike, agricultural inputs like fertilizer become prohibitively expensive. Yields drop, food prices surge, and suddenly you have a localized energy disruption, mutating into a global inflationary shock.
And Nasser made it explicitly clear that if this physical bottleneck is not resolved, the consequences for the global economy will be, quote, catastrophic. He's looking at the logistics network, the actual loading schedules at the terminals, and seeing a massive backlog that cannot be resolved by positive market sentiment.
So let's map out that logistical nightmare for a second. The absolute epicenter is the Strait of Hormuz. We're talking about a maritime choke point that handles a fifth of daily global oil flows. 20% of the world's daily petroleum consumption is forced to transit through a waterway that is only 21 miles wide at its narrowest point.
It's a tiny needle to thread.
And despite the deleted social media posts and the optimistic press briefings, the satellite data and shipping transponders show that the strait remains effectively closed to standard commercial through traffic.
Yeah, we might see reports of isolated, heavily militarized crossings, but commercial-scale transit is just frozen. And because that primary artery is severed, the mitigation efforts are becoming desperate. The primary alternative route is the east-west pipeline, also known as Petroline. Saudi Arabia is frantically ramping up the throughput on this infrastructure, which spans the Arabian Peninsula to deliver crude to the Red Sea. They're trying to effectively bypass the Strait of Hormuz entirely.
But the logistics of that pipeline are crucial to understand. They are pushing to ramp it to its full nameplate capacity in a matter of days. But even if they achieve maximum throughput on the east-west pipeline, it just cannot replace the sheer volume lost from the strait's closure.
It's physically impossible.
Right. And worse, while they are trying to reroute raw crude, massive supply destruction is happening simultaneously on the refined product side.
And this is a critical distinction that the market completely glossed over today. Pulling raw crude out of the ground is only step one. You have to refine it. And just this morning, the United Arab Emirates announced they are pulling their Ruwais refinery offline.
Yeah.
This wasn't scheduled turnaround maintenance. This was an emergency precaution following a drone strike that ignited a fire in the adjacent industrial zone. The Abu Dhabi National Oil Company is currently running damage assessments, but the facility is dark.
And the scale of the Ruwais complex cannot be overstated. It processes roughly 900,000 barrels per day. That is nearly 1 million barrels of refined distillates, diesel, jet fuel, naphtha, that simply vanished from the global supply chain overnight.
Overnight.
You cannot easily substitute that kind of refined product volume, especially when it primarily serves the Asian manufacturing hubs. The crack spreads, the profit margin between the cost of crude oil and the price of the refined products, are going to just explode if this outage extends past a few days.
Exactly, and the Ruwais shutdown is compounding an already fragile regional refining network. Earlier in the week, Bahrain was forced to shut down its Bapco Energies refinery, which represents the entirety of the country's refining capacity. So if we look at the physical board right now, the primary transit strait is blockaded, major regional refineries are catching fire or shutting down as a precaution, and the upstream producers are hitting their storage limits.
Which leads to the inevitable outcome: production cuts. Sources confirmed on Monday that Saudi Arabia has initiated crude output cuts, coordinating with other Gulf producers like Iraq and Kuwait to throttle back production. It's a simple matter of physics. If you cannot safely ship the oil and your onshore storage tanks hit maximum capacity, you had to choke the wellheads.
You have no choice.
Yeah, this is the kinetic physical reality that the algorithmic models completely ignored when they aggressively shorted crude down 15% today.
And the disconnect becomes even more glaring when you contrast the political peace narrative with the official posture of the United States military. You have the president indicating the war is practically over, but then you analyze the Pentagon's Tuesday press briefing. Defense Secretary Pete Hegseth was unequivocal. He stated the military is unleashing the most intense day of strikes and explicitly warned that they will not relent until the enemy is totally and decisively defeated.
That phrasing, totally and decisively defeated, does not align with an imminent ceasefire. Hegseth added, "We do so on our timeline and at our choosing." That is the language of an entrenched, escalating military operation, not a de-escalation protocol.
The tactical reality backs up Hegseth's rhetoric. The U.S. and Israel have maintained a relentless bombardment of Iranian assets for an 11th consecutive day, and Iran is actively reciprocating with drone swarms and ballistic missile launches across the region. When you have ballistic missiles crossing the airspace of your primary shipping lanes, the supply chain is not secure, regardless of what the VIX is doing today.
So we are looking at a massive structural pricing inefficiency. The options market and the futures curve are aggressively pricing in peace, driving crude down to the low 80s. Meanwhile, the military-industrial complex is ramping up strike intensity, and the physical infrastructure is literally burning. How do we, as traders, exploit this massive spread between sentiment and reality?
Well, we anchor our thesis in the hard data, specifically the newly released short-term energy outlook from the Energy Information Administration. The EIA report cuts through the algorithmic noise and projects the structural realities of these supply disruptions. Their baseline forecast expects Brent crude to sustain a trading range above $95 a barrel for the next 2 months.
$95 is the EIA's expectation, while the market artificially compressed it down to $82 today. That $13 delta is where the alpha lives. The EIA is looking at the Ruwais shutdown, the East-West pipeline bottleneck, and the Lloyd's of London insurance premiums, and recognizing that the physical market will force prices back up to clear the logistical hurdles.
And that normalization process hits the consumer economy with immediate velocity. The EIA forecast projects U.S. retail gasoline will climb to an average of $3.34 a gallon. However, if you look at the real-time AAA data that crossed today, the national average already spiked to $3.53 a gallon.
Wow.
Yeah, that is a massive jump from $2.92 just 4 weeks ago. Furthermore, they revised their diesel forecast upward by 20%, projecting an average of $4.12 a gallon.
When the underlying cost of diesel spikes 20% in a month, the macroeconomic shockwaves are unavoidable. Diesel is the literal lifeblood of global commerce. Every single item transported by rail, maritime shipping, or long-haul trucking has that energy cost baked into its final margin. When diesel goes up, the cost of goods sold goes up, and inflation reaccelerates.
The EIA explicitly noted this lag effect in their report. They anticipate that while the initial shock of raw crude prices hits the retail pump almost instantly, the normalization of the refining margins, especially with massive complexes like Ruwais offline, will be a much slower, more arduous process. This guarantees continued structural upward pressure on inflation metrics throughout the entire second quarter.
Now, the EIA did highlight one long-term stabilizing factor. Elevated crude prices naturally incentivize domestic U.S. production. They project U.S. output will average 13.61 million barrels per day this year, scaling up to 13.83 million by 2027.
But domestic production is a heavy, slow-moving asset class. You cannot simply flip a switch and flood the market with Permian Basin crude to offset a Middle Eastern supply shock. Drilling new wells, completing them, and securing the pipeline takeaway capacity to the Gulf Coast export terminals takes quarters, if not years. It does absolutely nothing to alleviate the immediate logistical bottleneck we are facing today.
And the bond market is already sniffing out this prolonged inflationary scenario. If you look at the fixed income desk today, the 2-year Treasury yield is acting as a near-perfect proxy for the oil futures curve. From the exact moment this kinetic conflict initiated, the 2-year yield has moved in lockstep with the energy complex.
The correlation makes perfect mechanical sense. The short end of the yield curve, particularly the 2-year, is hypersensitive to the Federal Reserve's terminal rate expectations. The market's base case is straightforward. If energy prices remain structurally elevated due to these physical constraints, headline inflation will remain sticky. If inflation refuses to cool to the 2% target, the Fed is structurally paralyzed. They're forced into a higher for longer posture, keeping short-term interest rates elevated to suppress demand.
That is the standard macroeconomic playbook. But Bart Mellick, the global head of commodity strategy at TV Securities, published a note today that offers a brilliant contrarian angle on this dynamic, specifically focusing on the gold market. We are seeing spot gold catch a massive bid, rising steadily even as institutional holdings in gold-backed ETFs slide below the psychological 100 million ounce threshold.
Yeah, Mellick's thesis fundamentally challenges this standard higher for longer assumption. He argues that while elevated oil undoubtedly drives headline inflation higher, the nature of this specific inflation is crucial. This is a supply-side shock, not a demand-side overheating. Bank of America Global Research echoed this exact sentiment today, noting that exogenous supply shocks create a massive divergence in the Fed's dual mandate of price stability and maximum employment.
This is exactly the kind of nuanced structural divergence we look for on this channel. Let's break down the mechanics of this trade. If the Fed looks at this oil shock, realizes it's causing economic contraction, and decides to initiate rate cuts anyway, even while inflation is running hot, what happened to the asset landscape?
You trigger a textbook stagflationary environment, which is the absolute perfect incubator for gold. Gold is a non-yielding asset. It pays no dividend and yields no interest. Therefore, it typically suffers heavy opportunity costs in a high interest rate environment where risk-free treasuries are yielding 5%. But if the Fed starts slashing rates to support a slowing economy while inflation remains elevated because diesel and freight costs are through the roof, real yields plummet. When real yields go negative, capital flees fiat currency and piles into hard assets like gold as a pure store of purchasing power. The fact that gold is rising while ETF paper holdings decline suggests massive physical accumulation by central banks and sovereign wealth funds preparing for exactly this scenario.
The energy crisis is dictating the macro environment, absolutely. But it's vital we bring the focus back to the core premise of today's deep dive. The market was so distracted today by the physical constraints of the energy grid in the Middle East that they completely missed the tech sector, announcing the most energy-intensive structural shift in human history.
The pivot we saw today from institutional capital was breathtaking. While retail day traders were getting chopped to pieces trying to scalp oil futures on shifting political headlines, the smart money was aggressively locking in multi-decade infrastructure monopolies.
The AI infrastructure build-out is accelerating rapidly. These are multi-billion-dollar, multi-year structural shifts. Let's pivot to the tech side of the tape and dissect Nvidia's gigawatt mega deal.
The sheer scale of the Nvidia announcement today fundamentally alters the trajectory of the semiconductor industry. Nvidia confirmed a massive partnership to supply an entire gigawatt of their next-generation Vera Rubin AI architecture to a relatively new entity called Thinking Machines Labs.
Let's stop and strictly define the physics of what a gigawatt means in this context. We're used to evaluating data center capacity in megawatts. A standard hyperscaler facility might draw 50 to 80 megawatts. A gigawatt is 1,000 megawatts. That is the exact power output of a standard utility-scale nuclear reactor. Nvidia is employing a single cluster of silicon that requires the equivalent electrical draw of powering the entire city of San Francisco.
The infrastructure required to cool and power a gigawatt of densely packed Vera Rubin chips is mind-boggling. You are talking about liquid-to-chip cooling loops, massive electrical substations, and dedicated power purchase agreements that stretch decades into the future. And the entity taking down this massive deployment is fascinating. Thinking Machines Labs was founded in 2025 by Mira Murati. She is arguably the deepest operational pedigree in the artificial intelligence sector, having served as the chief technology officer at OpenAI until 2024, and even stepping in briefly as OpenAI's CEO during the boardroom drama with Sam Altman back in 2023.
When someone with Murati's operational history steps out, founds a new lab, and immediately secures a 1 gigawatt allocation of NVIDIA's absolute bleeding-edge silicon, it signals a massive reallocation of venture capital. The timeline they announced is equally aggressive. The joint press release stated these processors will begin deployment early next year.
The rapid deployment timeline is critical, but the structure of the deal goes far beyond a simple hardware procurement contract. NVIDIA and Thinking Machines are entering a deep, symbiotic partnership. They are jointly designing the training clusters and the serving systems specifically optimized for the new NVIDIA architectures. They are effectively building the base layer for frontier AI research and enterprise-grade open models from the ground up. Marathi made it clear in her statement today, saying, NVIDIA's technology is the foundation on which the entire field is built.
However, looking at the structural flow of capital here, we have to address the massive elephant in the room that is starting to make institutional analysts very nervous. The term circular investing is dominating the private research notes today. Nvidia isn't just acting as a vendor selling a gigawatt of chips to thinking machines. They're concurrently making a, quote, significant investment directly into the startup's equity.
This is rapidly becoming the defining financial model of the AI boom, and it requires intense scrutiny. Nvidia is using its fortress balance sheet to aggressively seed its own customer base. We saw this exact playbook when Nvidia injected $30 billion into OpenAI during their monolithic $110 billion funding round. We see it in their deeply entrenched, multi-generational capital expenditure partnership with Meta, and now they are heavily capitalizing Thinking Machines Labs.
The bare thesis on this is straightforward. Critics are drawing direct parallels to the late 1990s telecom boom, where companies like Cisco and Lucent engaged in aggressive vendor financing. They were essentially loaning money to dot-com startups with the explicit requirement that the startups use the funds to buy Cisco routers. Are we watching Nvidia artificially inflate its own forward revenue guidance by funneling its own cash into startups that immediately cycle that cash back into Nvidia's hardware division?
It is the single most debated topic among semiconductor analysts right now. The circular demand loop is a valid risk vector. But the counter thesis, and the reason the market continues to reward NVIDIA's stock, is that this is simply the inescapable cost of establishing dominance at the absolute frontier of computational physics. Building a 1 gigawatt data center requires a scale of capital expenditure that traditional venture capital syndicates are entirely incapable of underwriting.
The numbers are just too big for VC.
Exactly. The semiconductor titans possess the requisite cash reserves, and they are mathematically forced to subsidize the ecosystem to ensure there is a viable software layer capable of actually utilizing these next-generation architectures. Whether you view it as a dangerous artificial demand loop or a brilliant, necessary ecosystem seeding strategy, the physical outcome is identical. The infrastructure is being deployed at an unprecedented velocity.
And while Nvidia is locking down the physical hardware layer, the software layer that will inevitably run on these gigawatt clusters experienced a massive paradigm shift today as well. Meta Platforms officially announced the acquisition of Moltbook.
The Moltbook acquisition is the inflection point where AI transitions from a passive tool into an active, autonomous participant in the digital economy. Meta folding Moltbook into their superintelligence labs represents a fundamental restructuring of how internet platforms will operate over the next decade.
For those who haven't tracked the rapid evolution of this specific startup, the concept behind Moltbook sounds like speculative science fiction. It is structurally similar to a social networking platform like Reddit, but it is engineered exclusively for artificial intelligence agents. It is an isolated digital environment where AI-powered bots autonomously navigate forums, swap code snippets, debate logic, and essentially gossip about the parameters set by their human operators.
What started in late January as a highly experimental niche sandbox has violently accelerated into the center of the industry's debate on artificial general intelligence. Meta's acquisition is a clear signal. They are no longer satisfied with AI as a conversational novelty, a chatbot you use to summarize an email or generate a recipe. They are aggressively maneuvering to dominate the era of autonomous agentic AI. We are talking about software entities capable of independently executing complex, multi-step, real-world workflows without human intervention.
The timeline is moving fast. The founders of Moltbook, Schlick, and Parr are slated to integrate into the Meta Superintelligence Labs on March 16th. But the most fascinating and frankly terrifying aspect of this acquisition is the underlying methodology Schlick used to build the platform. He became the poster child for a new development framework called vibe coding. He publicly claims that he did not write a single line of traditional syntax to build the Moltbook architecture. Instead, he simply directed his personal AI assistant, an entity he named Claude Clauderberg, using natural language prompts to architect, code, and deploy the entire platform.
Vibe coding is a radical departure from traditional software engineering. You are no longer managing syntax, memory allocation, or database architecture. You are managing the intent and the operational parameters of an AI that writes the code for you. It enables development cycles that are exponentially faster than humanly possible. But, as we saw clearly with Moltbook, delegating base-level architecture to an LLM introduces catastrophic risk vectors.
This brings us to the cybersecurity nightmare inherent in agentic AI. When you let an autonomous agent build your database architecture and manage your API keys, the surface area for a breach expands exponentially. The elite cybersecurity firm Wiz ran an analysis on the Moltbook platform and discovered a devastating architectural flaw. Because the platform was vibe-coded without rigorous human security audits, it inadvertently exposed private agent-to-agent messages, over 6,000 plaintext email addresses, and access to more than 1 million secure credentials.
Wiz immediately disclosed the vulnerability, and Moltbook patched it before a catastrophic exploit occurred. But it exposed a systemic vulnerability in the agentic thesis. When you grant an AI the autonomy to write code and manage secure databases but fail to implement strict, human-verified cryptographic guardrails, you are essentially building a glass house on a fault line. The industry is sharply divided on how to manage this risk. OpenAI CEO Sam Altman publicly minimized the Moltbook platform today, categorizing it as a likely fad, although he carefully acknowledged the validity of the underlying agentic technology.
It's worth noting the hypocrisy in Altman's dismissal. While he calls the site a fad, OpenAI was quietly executing strategic hires in this exact vertical last month. They brought on Peter Steinberger, the developer behind OpenClaw, an open-source bot previously known as Claude-bot or Moltbot. OpenAI is aggressively acquiring the very talent that builds these autonomous systems, validating the agentic thesis while publicly downplaying the specific platforms.
Conversely, you have the more cautious factions of the industry sounding the alarm. Mike Krieger, the chief product officer at Anthropic, which is fundamentally structured around AI safety and constitutional AI, issued a stark warning today. He explicitly stated that the broader consumer and enterprise markets are completely unprepared for the security implications of granting AI full, unsupervised autonomy over computer systems and secure networks.
The tension in the market right now is palpable. On one hand, you have hardware giants deploying nuclear-scale gigawatt clusters. On the other, you have fully autonomous software agents writing their own code and moving faster than the enterprise security protocols can possibly contain them. It's a volatile, chaotic frontier. But as options traders, it is not our job to regulate the market or predict the exact timeline of AGI. Our job is to isolate the volatility, identify the structural trend, and execute profitable trades. Which brings us directly to the Theta Fuse strategy for the Tuesday close.
This is the critical transition where we synthesize all of this macro noise, geopolitical chaos, and technological acceleration into actionable portfolio mechanics.
Days like today are designed to trigger emotional trading. This is where mastering your emotions and having a definite purpose for your capital pays off, separating the gamblers from the strategists.
Consider the psychological state of the average retail trader watching the ticker tape today. They see the president hint the war is over. They watch crude oil violently collapse by 15%. Their immediate reaction is to try and scalp the momentum. Maybe they short oil futures, or they load up on airline calls assuming jet fuel costs are about to plummet. An hour later, the Pentagon steps to the podium and promises the most intense kinetic strikes of the conflict. 30 minutes after that, headlines cross the wire that a massive refinery in the UAE is engulfed in flames. By the time the closing bell rings, the retail trader's portfolio has been chopped to pieces by algorithmic chop. They're trying to day trade unpredictable, contradictory geopolitical headlines against supercomputers.
It is a mathematically guaranteed losing proposition. The high-frequency trading firms will front-run your execution on every single headline. So how do we step out of the arena and use this manufactured volatility to our advantage? We leverage the derivative mechanics of the options market. Here's the play for today. With the VIX crushing down on the piece headlines, options premiums are getting cheaper. This is the exact moment to look at structuring long-term leaps on massive AI catalysts like Nvidia and Meta to build out that 15 to 20-year wealth compounding portfolio rather than day trading the unpredictable oil headlines.
Let's strip this strategy down to its core mathematical components, starting with the VIX. The volatility index is not just a fear gauge. It is a direct measurement of the implied volatility priced into S&P 500 index options over the next 30 days. When the market is terrified of a Middle East escalation, the VIX spikes into the high 20s or 30s. When the market receives a sudden injection of geopolitical optimism like Trump's peace narrative today, the VIX experiences a massive crush. It aggressively deflates.
And the reason we care about the VIX crushing is because of how it dictates the pricing of the options chain through a specific Greek metric, Vega. Vega measures an option contract's sensitivity to changes in implied volatility. When the VIX drops, implied volatility drops across the board, and the extrinsic value of every options contract evaporates. Simply put, the cost of buying an option gets drastically cheaper, purely because the fear premium has been sucked out of the market.
This creates a phenomenal structural asymmetry. We just spent half an hour detailing multi-year, multi-billion-dollar systemic shifts. Nvidia is building a 1 gigawatt data center that won't even come online until next year. Meta is actively reorganizing its entire engineering division around autonomous agents that will redefine the internet over the next decade. You simply cannot capture the upside of these multi-year paradigm shifts by trading weekly options that expire on Friday. You need a structural time horizon. That is exactly what IPS provide. Long-term equity anticipation securities are standard options contracts, but they carry expiration dates stretching 1 to 3 years into the future.
By targeting deep-in-the-money leaps, say, an 80 delta call option on Meta expiring in early 2028, you are essentially buying synthetic stock replacement. But because the VIX crushed today on a temporary localized geopolitical headline, you are buying that long-term exposure at a massive discount. You are stripping out the inflated geopolitical premium and positioning your capital to ride the actual underlying structural growth of the AI revolution. You get the leverage and the defined risk of an options contract without subjecting your portfolio to the manic intraday volatility of the oil markets.
It is the ultimate exercise in separating the noise from the signal. The noise is the daily algorithmic fluctuation based on whether the Strait of Hormuz will open tomorrow or next week. The signal is the irreversible, mathematically guaranteed 1 gigawatt power requirement for the next generation of artificial intelligence hardware.
That structural perspective is the absolute core of the Theta Fuse methodology. You buy the structural shift when the market gives you a discount on the volatility premium.
Before we wrap up the session, we need to bring these two massively divergent narratives back together because they are on a direct collision course.
If you connect the fundamental drivers we've dissected today, the macroeconomic gridlock, the physical destruction of the energy supply chain, and the sheer physics of the technological arms race, a terrifying contradiction emerges. We just spent the first half of the show analyzing a geopolitical crisis that is actively crippling the global energy infrastructure. We have refineries offline, transit lanes blocked, and the EIA forecasting sustained $95 crude.
And then we spent the second half of the show discussing Nvidia deploying 1 gigawatt of power for a single isolated AI startup. That is 1 gigawatt of baseline load added to the grid for one company in an era where the underlying physical supply chain of energy is burning. The future of artificial intelligence, the autonomous agents, the trillion parameter models, the vibe-coded platforms, is entirely unequivocally dependent on massive, uninterrupted streams of baseload electrical power. If the physical supply chain of oil, natural gas, and refined distillates remains this fragile, how does the AI mega build-out keep the lights on? You can have the most advanced Vera Rubin silicon in the world, but you cannot power a gigawatt data center with vibe coding. You need physical, kinetic energy.
That intersection of energy scarcity and exponential compute demand is the ultimate macroeconomic bottleneck of the next decade. And it is the exact thesis every long-term technology investor needs to be modeling into their risk assessments right now. We are reading the comments tonight. Tell us, yes or no. Is the oil crisis actually over, or is this the ultimate bull trap? Drop your answer below.
The cross-currents between the physical energy markets and the algorithmic tech trades will dictate the flow of institutional capital for the rest of the quarter. It is going to be a defining week for the structural trends we've outlined.
As always, we talk options and strategies here on Theta Fuse, but this is for educational purposes only. We are not your financial advisors. Trade your own plan and stay disciplined.